right, our next guest recently warned about contagion risk from stress in the private credit sector. Joining us right now is opportunistic credit investor Victor Khosla. He's the founder and chief investment officer of Strategic Value Partners, which has $22 billion in assets under management. And Victor, welcome. It's great to see you today.
Thank you. Thanks for having me.
We just introduced you as an opportunistic credit investor. What's the difference between distressed debt and opportunistic credit investing?
Opportunistic is so much broader. So classic distressed debt is buying stuff at 50 cents, trading it, selling it at 70, 80 cents.
Right.
Opportunistic, the way we think about it, is buying control of businesses, sometimes through distress, buying control of assets, fixing them, improving them. It's just much more hands-on, much broader in terms of what we do.
But something has to look like a value proposition to you. And
yes.
That usually means that it's under pressure.
Yes.
Okay.
We like pressure.
You like pressure. You must be happy right now. What are you seeing in the credit markets right now?
You know, and Becky, if I may just kind of even set it up, right? Yeah. For the last couple of years, the credit markets have been really pressured. You've had higher interest rates, high default rates, even while the overall equity markets were strong, right? Mm-hmm. So we were pressured coming in. Over the last quarter, you've just amping up pressure. Software, the threat from AI, the Iran war. My gosh, before it was all these sticks piling on the credit markets. Now we got lumber, right, piling on the credit markets.
So you look around and you see great opportunities, but do you also see the risk of contagion? Yeah,
no, the risk of exactly right. So the opportunities have been developing over the last couple of years. For somebody like us, and this may help, we have been selling more than buying, much more. We've been monetizing, realizing, selling more than what we've been buying.
Well, so then you haven't thought that there's been opportunistic places to buy in? There has been enough pressure?
Over the last the pricing, the deals, the values. Over the last quarter now, we're starting to ramp up. So with all this stuff accumulating out there, our pace of investing is really starting to step up.
What's the problem been if you're looking at, I mean, we've been looking at marks in some places that went from 100 cents on the dollar to zero. How does that happen with no stops in between? And what does that tell you about the other marks that are out there right now?
You know, marks are, they're businesses like software. When they fall, it isn't like there is a 10% or a 20% decline in cash flow. When businesses like software get into trouble, they just collapse. So part of what you're seeing with these marks, which go from 100 to 0, and there aren't that many of them, thankfully, okay? But what you are seeing is businesses which are just imploding with kind of changes in technology taking place. I don't think that's normal.
Do you think it's real? Because there have been a lot of people who have said, hey, don't believe the hype with this. Don't believe the sell-off that you've seen in the market, that many of these companies are going to do just fine because you'll still want that software vendor to be using even whatever AI comes along, and you'll still use that vendor.
Look, the telecom crash in 2000, 2002, and I was in the markets then, 25% of telecom debt defaulted over multiple years. The oil and gas crash in 2014-15, 35% defaulted in high yield and leverage loans and direct lending. Software, same thing. You've started the same thing again. It's not, we don't think it's like it's a hiss, not a pop. I heard somebody smart say this a few weeks ago. I really like that characterization, but that's where we are.
So are you going to be a buyer? Are you a buyer at this point in areas like software?
No, in fact, for us, the contagion which is starting to take place, you can, you know, when you get this sort of impact on a large sector of the high yield market, the contagion runs through. So we are really focused on real economy businesses. Manufacturing has been in a 12-month recession in the US and Europe. Consumer brands are troubled. Chemicals are having a once-in-a-generation down cycle. Home building, you know. So I think to our way of thinking, it's that contagion which is creating that opportunity where our investments are going.
It's not a baseline for you, though, that we wind up in a recession, is it?
It's not. Yeah, you know, the positive impact of technology, just how it is driving economic growth. We think there are two things conflicting with each other. A real economy which is really troubled with a technology business which is really driving growth, CapEx investing, right? Our base case is there's no recession, but our base case is at the same time credit spreads widening out substantially from here. And that has happened in the past. You know, a decent economy, okay equity markets, and credit spreads which really kind of widen out dramatically.
Have you been saving up cash as kind of dry powder for a time like this?
Yeah, we are. We've got, you know, of the 22 billion,
yeah.
7.5 billion is dry powder.
Really?
Yeah.
That's a huge percentage.
It is. So we're kind of ready in terms of what comes now.